Hello guys and welcome to another video. My name is Mark, I'm an entrepreneur and property investor. And in today's video, we're going to be focusing on property investing and the 3 ways that it makes you rich. And the third one in my list is something that people don't talk about enough and I really want to cover on this channel. So stick with me, I'm going to make sure that by the end of this video, you understand how property investors get so wealthy over time. Now, if you like this sort of content, please give this video a big like. It really does help me out with the algorithm. I'm filming this on the Wednesday. I'm going to upload it on the Wednesday and it's going to be with you on the Wednesday, and I'm going to make sure that I upload every Monday, Wednesday and Friday from now on to make sure that I am sticking consistently with my schedule for you guys. So subscribe, like, do all that stuff. Let's get into the video. Now, the first way that you can get rich with property is, first of all, when you buy a property. So let's say, for example, we can go out tomorrow and find a house that's worth 200,000. And because the seller needs to sell in a quick manner or to an investor that's not going to pull out, we're able to negotiate a discount. Well, with that power, we can make a substantial amount of money very, very quickly. Maybe we could get 10% off and make 20 grand. Maybe we get as much as 20% off and make 40 grand on the day that we buy it. So the first way that property investors get really, really rich is by being able to negotiate. And just to be clear, you can't do this with the stock market. You can't do it with index funds. You can't negotiate the price. Only with property are you able to go to the seller and come up with a solution to their problem and be able to negotiate a profit for yourself on that first day. So that for me is the first way that property investors get really wealthy over time. And I've got a working example of how I did that. I had a house in Corby in 2020. It was totally run down, boarded up windows. It looked absolutely awful. I'll put a picture on the screen. You can see how terrible it was. It was up for 145,000. I negotiated that down to 116,000. I then spent about 35 to 40,000 on a renovation, and at the end of it, it was worth 210,000. So you can see there's a big profit in there just because I was able to negotiate the price down. Now, if I'd paid 145, spent 40,000, there would only been a small amount of margin in it for all the effort that I made. So the numbers had to work for me. And when I spoke to the seller, I explained that I'm an investor, I have to make a profit. And there needs to be this margin so that if things go wrong and my renovation costs go over, I'm not burnt. And if it all goes to plan, I make a decent profit. And with that explanation, I was able to secure the discount and I was able to get that over the line and make a good amount of money on that deal. The second way that property investors get wealthy is understanding their numbers. And what I mean by that is when you buy, renovate, refinance, you have to understand that that's the deal you're in. If you're going for something where you're going to buy and just rent it out, you have to understand your ROIs in terms of this is what my costs are going to be, this is what my margin's going to be, and I'm going to give you some really easy to understand sort of formulas for you to follow. So if, for example, you're buying a single let property, you want to get about 10%. If you can get 8 to 12% return on investment every single year, from year one, that's the sort of number you want to be hitting because that is a very standard, simple, low risk strategy. And because it's low risk, it's got low returns. Now, with risk and returns, this is the important thing to understand. The risk is guaranteed, the returns are only possible. So as we go up this risk scale, we have to understand that for the lower risk, we are going to get a lower return, but for a higher risk, we're going to get a higher potential return, not a guaranteed return, because renovations, for example, like I just said, can go over budget. And I'll give some examples of when I've got burnt and when things have gone wrong for me so that you can understand that it is only potential return. So the second reason is understanding your numbers. And the first one, single let, 8 to 12%, really bog standard, really good. If you're doing a HMO and you're looking to try and rent out on a multiple occupancy basis, you want to be getting 20%. And that's after you've done your work. So after you put the furniture in, after you've put in the cost for the renovation, the fire certificates, all those things, you want to be getting 20%. If you're not getting 20% for all that extra risk, all that extra work, then you've taken on the risk without having the potential reward. So 20% is the minimum number. And for lots of my HMOs, I was getting 30%. So that's the second one. Third one, if you're looking at a buy, refurbish, refinance project where you're going to buy, do some work and refinance it, you need 20%, 30% margin in it. If you're only getting 10% at the end of it, then there's not enough margin for the amount of risk that you've taken on. So we're talking 10 to 30% on a buy, refinance, rent project. And that should give you the majority of your money out when it comes to the refinance part of that deal. So make sure you get paid for the risk that you take on. Now I'm editing this video, as you know, I'm trying to do it all in one day, so it's a bit of a mess. I'm editing this video at a trampoline park because it's my kid's birthday today. And I wanted to say that I forgot to tell you about an example of when a buy, refurbish, refinance product has gone badly for me. Now I did one in Didcot and on paper it looked fantastic. I bought the house for 275, I was going to spend about 50,000, it was going to be worth about 385, 400, something like that. Now, the renovation went massively over budget. There were problems with the sewerage, there was problems with the footings, there was problems with absolutely everything you can imagine. And I had to buy it quickly as well. So what I thought was an absolute bargain ended up being a bit of a nightmare. And I spent 80,000 on the renovation. So it was supposed to be about 50, it came in about 80, so a 30k overspend. Now, I didn't lose money because I had enough wiggle room in the deal. And I'd made sure that I had enough margin in it from day one that I wasn't going to get burnt. But that is an example of where a 30k overspend comes in, and I can think of other ones, but that's an example of when there's just everything goes wrong that you can imagine. I mean, we're talking floorboards, we're talking, you know, we had walls that weren't where they were supposed to be, building regs that weren't followed before, and then we had problems with, you know, just loads of stuff, everything you can imagine. So that's a good example of where, you know, you rush to do a deal, you have to get it through quickly, you've got under pressure from the seller. It looks like a great deal on paper, and if I hadn't got a 20-30% margin in it, I could have lost money, but I didn't. I made a small amount of money, but there we go. I'm going to go back in and I'm going to continue with the video and the edit. Now the third way, and this is really, really important, everybody needs to understand this, is debt. Debt is so valuable, and the reason it's so valuable is two ways. Number one, it allows you to leverage your profits. So the first one, if we look, for example, £200,000 house, we put down £50,000 as a deposit. Over the course of 10, 15, 20 years, the house doubles in price. We then netted the 200,000 as profit. So we've only put down 50,000, but we've got 4 times that in return by the 200,000 growing to 400,000. So that's what we call leverage. It works in reverse as well, which means that if property prices go down, and in the short term, it's always possible. In the long term, it's never happened, right? If you take a line and you draw it as far as you want, eventually they're going to come up and they're going to be higher than they currently are. The reason is inflation, and inflation means that properties will always have to be worth more in the future. So in very rudimental terms, debt allows leverage, which allows you to then take more profit from the money that you have in the future. Now, the second reason debt's really important, and the reason why all of my loans are interest only, and I'm not going to encourage everybody to do this, I'm just going to tell you what I do and why, is that debt becomes worth less over time. And the reason is, again, inflation. So if I held, and I do hold, about £2 million worth of debt in 2020, today, in real terms, that's about 1.5 million. So I've made £500,000 of real term value during that period of time. And this is really important to understand, because if you string that over a 20, 30, 40 year, and my exit strategy for my property investments is death. So because it's death, I'm looking at maybe I'm 41 years old, maybe I've got 45 years left, hopefully maybe more. But over that period of time, I would expect the £2 million of debt, and I will take on more and I will buy more, but that £2 million we have today will probably only be worth in the future about £200,000. Whereas the properties are going to double and double again, probably, and maybe even 3 times over that period. So we'll go from 4 million to 8 million, 8 million to 16 million. So I'm going to have like £2 million worth of debt on 16 million pounds worth of property. It's going to look very, very insignificant. So inflation is really, really important to understand, and your time scale and time in the market is key when it comes to property investing. Now, the first thing I talked about, being able to buy undervalue, to be able to make some money in day one, that really is the ability to be able to make money quickly. Inflation is going to take time to erode your debt. But believe me, I bought my first property for 176,000 in London in 2010. I took on £130,000 worth of debt. I have since refinanced it and taken more money out. But if I still held £136,000 worth of debt on that house, and it's now worth £500,000, £600,000, I'd be sitting there looking at the spread and the loan to value going, I have got so much equity in that property. And during this phase of my life where I'm trying to grow my wealth, I'm refinancing properties, buying more, doing more deals. So that's the strategy that's underway at the moment. But as I approach my 50s, I'm going to slow that down. I'm going to allow inflation to take care of the debt. And I'm going to allow inflation to also increase the value of the houses and the rents. And those spreads are going to become bigger and bigger and bigger over time. So what are your thoughts on this? What do you think the key things with property investing are? I'd love to hear from you. I'm going to answer every single comment, as I've always said. And if you want to have a one-to-one conversation with me, just look in the description. There's a box in there. You can just tick it, book a 15-minute free call with me. Everything's free. I'm not going to try and sell you anything. There's nothing to buy. So just book a call and we can have a chat. And I'm going to be doing that until I've got 10,000 subscribers. So guys, I hope you like this video. I hope it's cleared up some things and I'll see you on the next video. Cheers, guys.